Gavin Williams from Schroders. Welcome to the Growth Symposium.
Thanks, Drew. Great to be here.
Can you expand on the strategy of the Global Recovery Fund? Are you deep value investors where others are feared, others fear to tread?
Yeah, it's an interesting definition. What is value, deep value? What we would say is we're disciplined value investors. Every manager, whether you're value or growth, sees upside value to your position. So it really comes down to your process. Our process fits into that traditional value investing and starts with the cheapest quintile. It's a bit more complex than that, but that's effectively how it comes out. And from there, we basically do fundamental bottom-up analysis on every stock. We have 7 key questions which we ask, and the answers to those provide us with an outcome in terms of risk and either upside or not value. And based on those answers, we then build a portfolio, normally between about 40 and 70 stocks, which we think offer a good long-term return. So whether that's deep value or core value, for us, it very much fits into that value part of the portfolio.
And value traps are often, a big destroyer of capital. How does Schroders go about avoiding them or identifying them?
I mean, the value trap's an interesting one because you're normally looking at stocks that are cheap, they've been falling in many cases. So which ones will keep on falling? Which ones have a thematic reason for falling that could see that turn around? There's also traps in growth parts of the market. We've seen Tesla rise 850% over the last 5 years. It's off 50% in the last year. So this exists everywhere and comes back to that, what the outlook is. Our way of answering that is really those 7 red questions. How much money does the company make? How long do we think they'll make it for? And what are the risks to that? So things like balance sheet strength or missing liabilities, things like that is how we go about avoiding those value traps. So as much information as we can get. And in fact, we often don't meet with company management so that we can just read the data rather than relying on what the C-suite are providing us.
Can you walk us through what the value archive is?
Yeah, sure. The value archive is a really important part of our value add, and it houses all of our analysis, those 7 red questions that we have, what fair price we put on stocks, all the financial modelling. So effectively it allows us to go back and revisit any of the previous analysis that we've done in a very easy way. So if it will have a fair value, a stock price. Should a stock price fall to a previously designed level where we'd say it's now fair value, we can revisit the other fundamental inputs and decide whether it now has enough upside potential. It has our risk score. So not only do we look at potential upside, but we look at what the risk of it falling further is. Something with a very high risk weighting, even if it has a high upside, would have a very small position in the portfolio, if at all. The other important part of the value archive is that it allows us to analyse previous decisions made. So we have over 3,000 stocks in that portfolio, in that value archive. We can look at where we've made good decisions in the past, and importantly, where we've made bad ones. What did we miss, or what did we include that we should have not done? And that allows us to evolve and maintain a better process. And an example of that is some of the analysis has shown that we're very good at our entry level on buying a stock, but we're often a bit early selling, which kind of makes sense because we're then rotating that cash back into another position. But that's the sort of analysis we can get out of that value archive.
And we've seen a resurgence in value investing, or the performance and the differential to growth has kind of slowly closed. What's the catalyst for it to continue?
Yeah, I think one of the big drivers of that growth, along with many factors, but one of the big ones over the last decade or so has been a lot of injection of liquidity into global markets, which had to find a home somewhere and ultimately found a home in many cases in asset prices. That can be seen everywhere from growth stocks, but also house prices in Australia have been a beneficiary of that. So what we've sort of seen is a resurgence in more traditional fundamental valuing of companies, which has supported more of that traditional value trade rather than the growth trade. So in terms of that continuing, we don't see that central banks, through what they've been saying in their narrative and also their actions, are keen to go back to that high liquidity environment, very low interest rates and high levels of printing money. They'll do so in episodic periods, which we've seen recently with the banking sector, but we ultimately see that inflation looks to be higher than where it's been and stickier, and therefore we're likely to see a more normal pricing. And given there's still relative large dispersion between value and growth, there's quite a bit more of value to catch up to close that gap.
And has your definition of value changed? Is it still looking for cigar butts, as Benjamin Graham would say?
It hasn't changed. We're still starting in that cheapest quintile.
Yep.
What we do have to do is sometimes extend the period over which we look at their valuations, because it has been an elongated cycle. So where we might have taken an average 10-year view of their long run valuation, that might have become 12 or 13 or 14 years to make sure we're capturing that full cycle, which, as I said, has been elongated by the central bank sort of support of asset prices, which has now pivoted away. But the ultimate view that value still is that cheapest quintile. And that is important because when you look at the long run average returns of value versus growth, that's over 120 years of strong data where there's inflationary, deflationary, economic growth, economic decline. There's a lot of scenarios, and that gives us the confidence that this will still be working, notwithstanding the recency bias of the last 10 or 12 years.
And what's one of the most compelling ideas in the fund at the moment?
There's a lot of really well-known names. I think some people look at the portfolio and think initially it's going to be a whole lot of distressed companies, but when you look at it, there's a lot of very strong, well-known, reputable names in there. So I thought choose one that's a little bit different. Mohawk, which is a flooring manufacturer. It's best in class, has a very strong balance sheet, and obviously some of the headwinds at the moment around concerns of economic decline, slowing consumer side, people maybe putting off the renovation or the new home build for a shorter period of time until that sort of recovery comes through. We think they'll do very well once that recovery comes through. So happy to look at the fundamentals at this point, buy the company, be patient, not be looking for that instant uplift, but be patient for that to come through in terms of the strength in their own product, the strength in their positioning within their market, and ultimately be reflected in their cash flows and the stock price.
Gavin Williams, thank you.
Thank you.